I am not an inflationist. The business cycle, when it picks up, will create some inflation again because oil prices will eventually rise and stuff like that. But I'm not an inflationist. There's two different things going on. There's debasement of currency that inflates asset prices. That's continuing. Inflation itself, I see less so. And all I see ahead is a tsunami of technology that is so deflationary we can't get our heads around it. So yes, we will get business cycle inflation. Where will inflation end up in this cycle? I think it ends up below 2% and then picks up again and maybe gets to 4% and then comes off again. So I'm not wildly concerned by inflation, but as we said, those prices won't fall. So we've still got that issue. But if I look further ahead, I think this is maybe the most deflationary period anybody's ever lived through because of robotics and AI. It's we're creating infinite people, or people in inverted commas, at zero cost. I mean, Amazon now employs more robots than people. So they're the largest employer in the United States, I think, outside of the Postal Service, or maybe the largest employer. But they have more robots now, and the robots work 24/7, 7 days a week, never complain, never take a tea break.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad, Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. In this video, Raoul Pal shares why he's bullish on Bitcoin, the S&P, and gold for 2025. Let's catch up with him to uncover his insights and predictions for the future.
Exactly. They never complain, don't have any HR issues, nothing. And so look, if you step back, it means that everybody is economically incentivized to use technology as opposed to people. That's a fact. So go to a Tesla factory, it's all robots. Go to any modern factory. So even if the re-onshoring of manufacturing in the US, a big Trump thing, they're not going to employ people. It's not the 1950s anymore. This is a very, very different world where nobody employs people if they can avoid it, because technology is so much cheaper and more effective. So what is going on is every 4 years, all of the major governments around the world have to roll the debt. Now, it's this 4-year cycle, something I call the everything code cycle, because in 2008, there was a debt jubilee of where they reset interest rates to zero. All of the governments, therefore, didn't have to pay interest for a while, so it was a break on interest. So it was like a debt jubilee. It's like, don't worry about it, guys. Don't pay your interest. Sort out your debts. They all restructured their debts into the 3 to 5 year sector, and so 4 years being in the middle of it, and it's created this perfect cycle that's been happening since 2008. What has happened this time around, because we had the pandemic inflation, it's been very late for them to cut rates. Normally, in this point in the cycle, they would have cut rates back down to trend rate of GDP growth, let's say 2%, but they couldn't. So what's happening is the debt is now compounding into new debt because they're issuing new debt to pay old debts. And so what you've got is a tsunami of debt that's happening, which is why they need to get interest rates down. So it's that dynamic that's causing it, is the issuance. Something will give at some point. Either the governments are going to have to stop it because everyone's got the same problem. And the UK interest rates just hit it was like a 30, 40-year high. It's unsustainable in highly indebted economies. So they're all going to have to do something. Now, whether it's a yield curve control idea, which is they kind of, as opposed to forgiving all the debt payments, they say, we're going to cap interest rate on government debt at X%. Or you have to do QE, but certainly what they're desperate for is to add liquidity into the system. There's a tightness in liquidity that stops people buying the bonds, which is why the excess issuance isn't being bought. The other issue is the dollar's too strong. So it's expensive for the Japanese and the Chinese and the Europeans to buy US government bonds. So again, it's another reason they've got to get the dollar lower, got to get the rates lower. And then I think it will free up the 10-year. Trump has already said interest rates are too high. And I think Scott Bessent's first job is to figure out this particular mess.
Arthur Hayes, co-founder of BitMEX and chief investment officer at Maelstrom Fund, has expressed skepticism about MicroStrategy's Bitcoin acquisition strategy, which heavily relies on volatility. In a recent interview with Benzinga, Hayes critiqued the company's use of convertible debt to buy Bitcoin, stating that this approach thrives on Bitcoin's price swings. He warned that as Bitcoin's volatility diminishes, likely following a significant market crash, MicroStrategy could face difficulties attracting interest in these financial instruments, potentially jeopardizing its entire strategy. MicroStrategy, under the leadership of Michael Saylor, has gained fame more for its extensive Bitcoin holdings than its core software business. The company's stock has surged 62% in the past 3 months, propelled by Bitcoin's 50% rally. However, Hayes cautioned that a decrease in volatility could spell trouble, emphasizing that he would avoid trading MicroStrategy stock altogether, suggesting better ways to invest in Bitcoin. This critical view adds to existing concerns, with figures like Peter Schiff and Martin Shkreli also questioning the sustainability of MicroStrategy's approach. Yet, others like Anthony Scaramucci continue to support the strategy, arguing that fears of liquidation during market downturns are overstated. As Bitcoin's price currently hovers around $93,573, all eyes remain on how Saylor's bold play will unfold in the face of market shifts.
Look, I think, again, if we talk about the equity market, that bifurcation, I think it makes no difference to Google, Apple, Meta, OpenAI, none of these guys, because those guys compound growth at 30% a year, so a 5% hurdle rate. Don't forget, they all sit on cash. So they actually make more money as interest rates go up, which people don't realize. So I'm not worried about that. If inflation came back, then you have to discount the cash flows. But with rates up, it's not an issue. It is for the regular economy, which creates this bifurcation. And I think that, look, there is a risk that it goes to 5% and 5.5%. So I think there is going to be some pressure from Trump to organize this as fast as possible. The other side of the equation that makes some complexity to it is Trump wants to renegotiate trade terms with everybody, whether it's Canada, whether it's China, whether it's Europe. And the best way to beat everybody into submission is a strong dollar. And so, because they all have dollar debts as well. So what he's going to do is use the strong dollar as the stick and then offer the carrot. And the carrot will be, we will lower the dollar if you agree tariffs or changes in the trade deficits.
Bitcoin traders face a week of uncertainty as the U.S. presidential inauguration approaches, with the strongest U.S. dollar since the 2022 bear market posing significant risks. The cryptocurrency market, already fraught with volatility, must now navigate a range-bound BTC/UST situation, with key levels likely to define price action around the January 20th event. Bitcoin's price risks both upward and downward surprises as traders eye the impact of macroeconomic factors. Core inflation data expected this week could further complicate the picture, as the Federal Reserve's recent hawkish stance leaves little room for interest rate cuts, a situation that strengthens the dollar and weighs on crypto. The Fed's challenge in containing dollar strength, now at its highest since late 2022, creates additional headwinds for Bitcoin. Meanwhile, Binance's buy/sell ratio hints at a potential shift in market sentiment, as buyers seem poised to gain strength. Exchange inflows are also cooling, suggesting that many traders prefer to hold onto their BTC, as Bitcoin consolidates within the $90,000 to $96,000 range. Analysts like Cret Nouveau identify key liquidation levels that could trigger significant moves. Fellow traders emphasize the importance of maintaining $93,000 to avoid further downside, with some speculating a possible test of $85,000. On the macroeconomic front, the week brings crucial data, including the Consumer Price Index (CPI) and Producer Price Index (PPI) for December 2024. These figures will guide the Federal Reserve's upcoming decision on interest rates. With inflation climbing alongside unemployment, the Fed faces mounting pressure, and the crypto market watches closely. Market commentators highlight that the Fed's hawkish pivot has diminished expectations of rate cuts, dampening sentiment in both crypto and traditional assets. According to the Kobayashi letter, this week's inflation data will be pivotal, potentially setting the stage for prolonged higher interest rates. The U.S. dollar's current rally, intensified by anticipation of the presidential inauguration, adds to the volatility. The dollar index, DXY, has reached levels not seen since October 2022, when Bitcoin was nearing its bear market bottom. Analysts warn that continued dollar strength could hinder risk assets like Bitcoin, though some traders see potential for a breakout should the dollar falter. Market research suggests that above certain levels, the Fed might intervene to prevent systemic issues, with the dollar's recent highs drawing comparisons to past breaking points. And do not forget to subscribe to Bitcoin Zella. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.